get in Rajat Jain, CIO at Principal Mutual Fund, who joins us right now on the show with his thoughts. Rajat, good having you. Thanks much for joining in. Rajat, the first name that I thought of yesterday when this whole news bit about the next round of repayments for the NBFC paper came out was you. I'm glad that we are talking today. Are you worried about this, or now the market is used to, and with the liquidity situation being a lot easier than what it was in the round one, the NBFCs will manage, you think?
I think the market's clearly discriminating amongst NBFCs. So there are select NBFCs, those either supported by corporate groups and who generally don't have a large wholesale book, and they are finding clearly they are getting funding easily, and others, and it's a continuum. So you are finding NBFCs down the ladder who are certainly finding it more difficult to get refinancing. But overall, while the refinancing, I mean, the availability of money has eased, but the market is discriminating among NBFCs and NBFCs. So people who tend to have a more wholesale sort of an asset book are clearly finding it more challenging. Not that they are finding it, they are getting money as well, but they're finding it more challenging to raise monies compared to those who are either backed by corporate houses or have a more granular retail exposure.
Yeah, but Rajat, do you believe that there could be a systemic risk of shorts when these large repayments are bunched up, or do you think that the space at large will manage? There could be individual casualties, but do you think there is a system-wide risk of, if not blowing up, but slowing down considerably?
No, I think it's more of the former. I think it's more limited to specific names, specific companies. I don't think it's a systemic risk there yet. It's more about companies who are over-levered, who have wholesale book, who have ALM mismatches. I think probably the issues are more sort of in segregated in that piece of the NBFC bucket. It's not really a systemic issue yet. I don't think it's systemic. It's more of select names having trouble.
Hi Rajat, good morning. What we've been witnessing in the markets, especially the broader markets, investor confidence is turning weak right now. And just going by BofA IML's recent, global fund manager survey for the month of June, which indicated that the investor confidence is at the lowest level since global financial crisis. That's about the global markets. But back home, what sort of investor confidence are you gauging from the investors who are putting money in your mutual fund?
No, I think in the news, if you look at the news, if you look at the macro news, but for the oil prices, which have tended to go up because of geopolitical reasons, and things on US, Iran, and so on and so forth. But otherwise, the oil prices have behaved. But if you look at the inflation, you look at the kind of currency reserves we have, the current account deficit, things to be under control for India. I mean, things are not great, but we are not bad. I mean, we are doing okay as far as the macro indicators are concerned. It is, however, we are seeing, say, news, for example, yesterday, there was so much of talk, and we have seen that, I mean, for the last 4 or 5 or 6 months now, slowdown in the auto space. We have seen some good demand from cement. We've seen some pricing increases taken by cement players last 2 or 3 months. That's somewhat moderated. So at the micro, and of course the recent news on the rain, on the monsoons, June is substantially negative, about 40% if I remember right, for the country as a whole. And the country, so there are a lot of micro parameters where the country is, waiting for, positive developments. And as regards, so I think the way it really plays out is the consensus earnings estimates for FY20, which range, actually there's a wide range, but they range somewhere between, say, 20% plus 22-23%, while a good chunk of that does come from corporate oriented banks, but those numbers probably could tend down a bit. So there is, so all said and done, I think it's about a lot of the news flow that you're seeing at the micro level, which is making investors somewhat cautious at this current phase. But having said that, having said that, I think the way the markets are positioned, valuations have substantially become more attractive, certainly for the mid-cap space and somewhat for the small cap space. So if you're investing for a 3 to 4 year horizon, clearly there is space in your portfolio to have those sort of stocks. Though I think this current financial year, FY20, doesn't look like being a great year for equity markets.
Okay, so in light of that, Rajat, what you're indicating, it may not be a great year because of higher valuations and earnings estimate that you were talking about, 20 to 22%. I believe they've already started to scale lower. But still, Rajat, if somebody wants to put money in the market right now, which are the sectors that even at your mutual fund, you guys are looking at closely, where you're finding some bit of valuation comfort?
See, the market as a whole is not attractive, but what's happened, there's a huge, dichotomy or divergence in the valuations of certain sectors which are really expensive, say some select stocks in the consumer space as an example, and then there are other sectors which are more reasonably, I mean, they're not cheap, but say they could be in the low teens or mid-teens sort of valuations against, say, 40s or the 50s that you're finding in the consumer space in terms of PE multiples. So in terms of our portfolios, we kind of like corporate oriented banks, which is a consensus call, because we've seen the story, we know as to why that's happening. Moderation in NPAs, most NPAs having been provided for, incremental creation is low, NBFC is getting out of the market, so all of that is positive for banks. So corporate banks is something that we are long on. We are underweight autos in our portfolio, neutral to moderately overweight in the IT space. It is somewhat of a defensive. And while valuations are in line with broad long-term averages, and we got to watch for the global economy, how the global economy plays. I mean, the US economy still is doing reasonably good. And a lot of the growth in IT is geared to the US economy. So we continue to have a moderate overweight position in IT. So actually a more diversified portfolio, select services, for example. Hotels is something that we like. So it's a diversified portfolio across sectors. We're not seeing a single sector really stand out at this point of time.
Okay, Rajat, we'll leave it at that. Thank you so much for taking the time out and speaking to us at Bloomberg Quint. Really appreciate your time today.